Hello friends, a very warm welcome to my channel. We are going to talk about Sagility, which is a very unique company in terms of business model, and there are hardly any peers which are listed which have an identical business model as Sagility India. You can invest in this company as a proxy to the healthcare and insurance sector, not just in India but globally. Before we move forward, if you are new to the channel, please to subscribe and hit the bell icon to get updates of all the new videos that I upload. Here is a small disclaimer. As per SEBI regulations, you can pause the video and read it. This will be the flow of our discussion. We'll talk about the business model of Sagility in brief. We'll look at the stock performance in the last 1 or 2 years because it's a recently listed stock. We'll look at the financial performance of the company in the last 3 years. We'll understand why the stock has given a correction from the top. We'll understand the outlook of the management going forward. We'll talk about the valuations of the company. We'll understand the risks of investing in this business and then form an overall view. So this company was earlier called HGS Healthcare. It was owned by the Hinduja Group and later it was acquired by a PE firm called EQT. It's a business process management outsourcing company. So insurance companies, hospitals outsource their non-critical operations to companies like Sagility. It does this only for the healthcare industry and it specializes in that, and it is not a general KPO. So a majority of their customers are insurance companies, hospitals, clinics, etc. Now, what kind of processes does Sagility do? For insurance companies, it does customer engagement, claims processing. For hospitals, it does customer service, collections, payments processing, and several other such services. So now it gets paid in two models. One is on a per person basis based on the number of people working on their team of a particular client. And secondly, on the basis of per transaction basis. There are more than 40,000 people working in Sagility in India as well as abroad, and a lot of operations are done offshore. That is, the companies are abroad but their operations are carried on in India and countries like Philippines. There are 33 delivery sites of this company and they have clients across the globe and in US also. In the last few years, the company has tried to use advanced technologies like artificial intelligence to increase their efficiencies and output. And this business is not the same as MediAssist, which we spoke about in the earlier video. MediAssist is a TPA and this does not do insurance claims processing like a TPA. This does only non-critical outsourced business operations. Recently, they acquired a company called BroadPath. So this company does a similar business in United States. By the acquisition of this company, the company has increased its presence in US. So BroadPath has more than 30 plus mid-tier US clients and they have their own platform called Beehive. So by acquiring this company, Sagility has increased their penetration in US and increased the number of mid-sized clients. And they also have opportunities of cross-selling to the clients of BroadPath and also use their technology which they have developed, that is Beehive. They've acquired this company at a pretty reasonable valuation of less than one time EV by revenue. And in terms of EPS, also this is a accretive acquisition. If you look at the revenue split, 89% of the revenue comes from payers. Payers here mean insurance companies, and close to 11% of the revenue comes from providers, that are healthcare institutions like hospitals, clinics, etc. These are the main KPIs of this business. In terms of the number of active clients have grown from 35 from FY23 to 75 now. The number of new client additions every year, 7 new clients were added in FY23, 13 in FY24 and 38 in FY25. So they are growing at a pretty decent pace. In terms of client concentration, it is risky. The top 10% clients contribute more than 90% of the business. If you look at the number of delivery sites, they have increased from 27 in FY23 to 33 in FY25 and they have added 10 new delivery sites in FY25. There is no identical peer doing the same business in the listed space in India. One close match we can consider is as First Source Solution. So this is also not doing entirely the same business, but one part of business of First Source is similar to Sagility. So they have a US healthcare vertical in First Source which does revenue cycle management, claims processing, and patient engagement. It's a recently listed IPO in 2024 and the IPO price was 30 rupees. It did not have a strong opening or listing, but post that it rallied up to 55 rupees. From then, due to several reasons which we will discuss in the coming slides, it fell down to as low as 37 rupees and now it is consolidating at somewhere around 44 rupees. So this range of 37 to 45.50 is a strong consolidation base for the stock now. If you look at their revenue, they did a revenue of 4,200 crores in FY23, which increased to 5,500 crores in FY25. So there is a steady increase in revenue. EBITDA has also increased from 1,000 crores in FY23 to 1,468 crores, nearly 1,500 crores in FY25. So there's a decent growth in profits as well. The adjusted EBITDA margins have improved from 24% to 26%. So the company is considering adjusted EBITDA margins by removing the one-off expenditures. The adjusted ROC comes to 55%. There are some intangible assets worth 2,000 crores and goodwill worth 6,000 crores on the balance sheet of the company. So these kind of items come in when they acquire other companies or they develop in-house softwares or patents or trademarks. So legally speaking, all these accounting is good and permissible. But personally, I do not like companies which have huge intangibles on their balance sheet because this is kind of a gray area. It has a very strong cash flow. Nearly 90% of their EBITDA is getting converted into operating cash flow. Now, what is the reason for the fall in the stock price recently? The promoters did an OFS of 15% of their stake post the IPO. In fact, the IPO was also an OFS at 38 rupees. So this was below the market price and the stock fell. Even post the OFS, they have done block deals and sold their stake further and reduced it to nearly 67% now. So this kind of promoter selling is creating pressure on the stock. In terms of valuations, at one point of time, it became expensive. So the valuations have cooled off now and the market sentiment has also not been so great in the last 6 months. Before we move forward, if you're not a part of a Telegram channel, do join today by clicking the link in the description so that you join the correct Telegram channel. More than 7,000 people are daily in touch with me on a free Telegram channel. I discuss a lot of interesting market views, stock views on my channel that will help you increase your portfolio returns. Now, what are the growth plans of the company going forward? They are guiding for a double-digit revenue growth in FY26 and an EBITDA margin between 25 to 27%. There will be both organic growth as well as they are open to inorganic acquisitions. There will be cross-selling opportunities post-acquisition of Broadpath. They will focus more on doing maximum work offshore because they can do it in countries like India and Philippines and reduce their cost and improve their margins. They will use latest AI technologies to improve efficiencies in their work. Now let's talk about the valuations, which is the most critical part. The stock is trading at a PE of 38 times, PB of about 2.5x, EV/EBITDA of about 16, and market cap to sales of about 3.7x. For this kind of companies where the depreciation is high, EV/EBITDA would be a more suitable metric rather than looking at price to earning ratio, which visually appears to be high. Another way of looking at such companies is also by comparing the market cap with the cash flow, because the cash flows in such companies are generally stronger than the profit after tax. As you can see, 90% of the EBITDA is getting converted into cash flow. So either use cash flows compared to the market cap or EV, or EBITDA compared to EV or market cap. So trading at 16 times EV/EBITDA is not a very expensive valuation. But such companies would not get very high valuation as well, because there is very high competition from players in India and abroad. There are a lot of unlisted players doing this business. There are a lot of big IT companies who have verticals of healthcare doing similar businesses. And there are no high entry barriers in this business. So the valuations are reasonable, but there is a reason for that. Now, what are the risks of investing in this business? There is high attrition rate. The employees' attrition rate is more than 27%. Top 10 clients contribute more than 90% of the revenue. So if one client goes, a lot of business of this company is at risk. There can be changes in the US healthcare policy, which can impact the business of the company. There could be regulatory changes in India and abroad, which can impact the business of this company. Since they get a lot of revenue from outside India, forex volatility will impact the margins. There could be changes in the data policies or privacy policies in different countries. It's a very highly competitive business, and the promoter selling will always remain like an overhang on this stock. So now that you've understood the business model of the company, the growth aspects, valuations, risks, what is our overall view on the company? So if you're holding this company and you're happy with a moderate kind of a gain, you can continue to hold. But there is a high possibility that whenever the stock goes up, the promoters may come to reduce their stake because it's a PE investor. And if you're looking at a fresh entry, it totally depends on what kind of returns you expect from the market. If you're expecting very high growth, high returns, then this company is not expected to grow at a very high pace. And there are a lot of risks involved, like customer concentration, regulatory changes, overhang of promoter selling, etc. So overall, expect moderate gains, but your money is safe as it's a high cash flow company. So if this aligns with your goal, then you can consider investing in such businesses. So that's about Sagility India. I hope you like the crisp analysis. I've tried to cover all the important points in this crisp video. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, do mention in the comment section. Even this was picked up in the last video's comments. Do join our Telegram channel. Thank you for watching and have a wonderful day.